Hello and welcome back to the channel. Today we're starting a new series, Retail versus Smart Money. In this series we're going to recap trades that I've taken and I'm going to show you the retail perspective along with the smart money perspective so you can see why trading with order flow concepts is much more effective, gives you a lot more confidence in your trades and brings you better results. Before we get into today's video, I have a free trading course showing you the top 10 reasons why you're not winning at trading and how you can turn your results around. Now you can actually access this course right now using the link in the description, but I would stick around and watch this video first because you're going to find a lot of value in this. So the first trade we're going to look at today is AUD/USD. We started off on the 4-hour time frame here, and the trade that I actually took place around this area. If we look on the overall picture though, we'll start from the top. One of the concepts retail traders use, which is a good concept, is market structure. I obviously use market structure as well in my trading, but I use it in line with, liquidity, market efficiency, supply and demand. So I have a clearer picture of what is a real structure break and what is not. So to start this off, then we can see we came down from this point here. We formed lower low, lower high, lower low, lower high, lower low. And at this point, we broke through this high here and formed a higher high at this point. So this may have been the first area that a retail trader was looking to actually start buying for this pair, right? They know that, okay, the structure has broken. We can begin buying AUD/USD up when we get the right confirmation. Now, the next thing a retail trader may have been looking at then was this trend line here. So what we can actually see if we scale into the current price action is a trend line starting from the top. We had a retest, a retest, a retest, a retest, a retest, a retest, and then a break, right? And this break here is where the retail traders would have been looking to begin buying this pair. Now, if we also look at this floor point here, we can see this point was a support, this was a support, this was a support, and this was a support. So if we just grab this tool then, what we're going to see is a support floor. So now a retail trader has essentially a basic retail setup. This is a very common setup you're going to see if you follow retail traders, if you take education from retail traders, or if you trade these concepts yourself. Support, retest, retest, retest. What's that? A triple bottom. So if we mark that area out, that is a triple bottom. And at this point, we have a triple bottom in the market. So we have a basic retail setup there. And if we even add the stochastic indicator, which shows overbought and oversold conditions, you'll see that coming down into these lows, we had multiple oversold indications, which would have then led us to buy more because we think, okay, the market has sold off a lot. It cannot sell off further. So we could start buying with these other confluences that we have. So based on a basic retail pattern, then what they may be looking for is, well, if we just get some support areas in, they may be looking for a pullback, something like this, to retest the support and move up. Alternatively, a pullback down to retest the trend line and then move up. And those are essentially the basic ideas that a retail trader is going to be looking for. So how did this setup work out for the retail trader then? Well, initially we came down, we broke through that support. So any buyers who took buys here would have been taken out of that move. Then we pulled back down, we came near to the trend line, probably induced a few more buyers before pulling back up, failing to make a higher high, and then breaking down to the downside. So why did I see past this setup, and why is this a bad way to trade? Well, let's break it down step by step. First of all, a stochastic indicator, an RSI indicator, any form of oscillator that shows oversold and overbought conditions is a waste of time. They are not going to help you. I mean, if we just look at it real quick on the chart there, you'll see that we were getting oversold conditions all the way from this point here. So if you'd have been buying there, you would have lost. If you bought here, you would have lost. If you bought here, you would have lost. If you bought here, you would have lost. And the only area that you may have got a profitable position in from buying was if you bought right in these lows with these oversold conditions. So you can see one possible opportunity for profits versus multiple losses that you would have taken based on the oversold conditions. The second reason that retail analysis doesn't work too well and hasn't worked out in this opportunity is because the trend lines don't actually indicate a break of structure. Okay, so market structure is important. We know higher highs, higher lows, lower highs, lower lows, and so on. They do come into smart money and price action trading the same way as they come into retail trading. But the thing is, trend lines do not. Okay, a trend line is essentially a line that you've drawn on the chart and it doesn't actually exist in real time. Okay, so clearly we have had some resistance at this point. That is true. But if we see a break of a trend line, that doesn't mean that we've actually had a break of structure. So if we look at this opportunity, we can see this was the most recent structure point, significant structure point, the most recent retest of the level. From there, we had a little range and then we've pushed up. And this here, where we broke the trend line, is where traders will become interested in buying. But the problem is we haven't actually broken this structure point here. So until we do that, the structure is not telling us that we're bullish. If the market did come up, push over this high and then pull back, maybe that would be a more viable buying opportunity. Well, Personally, for me, it wouldn't, based on some other concepts we'll talk about in a moment. But until we break structure, we are essentially not changing the trend direction, regardless of what any random trend line tells us. So the trend line can be completely disregarded. Okay, they're going to lead you into a lot of losing trades. And yeah, they may work here and there. For example, if you were selling from trend line retests, you would have had about 2 good opportunities there. But for the most part, they're not going to work out how you want them to. And they are also prone to discretion, right? You may move the trend line. So the trend line may start out like this, focusing on these levels. But then when this high comes in, you'd move it, all right? And you can just continue moving trend lines. They're just a very ineffective way to trade. So we've looked at oscillators, we've looked at structure, and we've looked at trend lines. And now you know why we don't use those aspects. The next point to look at is the support and resistance level. So we can see here that there was a support point, and then when we come in and retest it 3 times, we may see that as a strong support level and a strong area to buy from. The problem with that is we actually want to be buying from areas of supply and demand. Supply and demand areas are where a lot of volume has entered the market. Now we can see that there's been a supply and demand area here where a lot of volume entered the market, showing us by this drive up. But we can actually see that this level has been pushed through with these wicks, and we do have a lot of imbalance or market inefficiency below. Inefficiency is what we call areas that are left open by price. Now, if we go back and look at some price action, you'll see that normally when we have an inefficiency, so for example, we have a drive up here, this is an inefficiency, the market comes through and fills the inefficiency before moving up. Once again, we open another efficiency there, market comes down, makes that price action efficient, and then moves up, right? So this happens a lot. Now, as we can see, we have inefficiency here, we have inefficiency here as well. So for me, buying from a support level, so to speak, which is literally just a level that price has bounced from before, is not a good idea when we have other clear demand zones and supply zones around. So this support for me is no good. I would prefer to be buying from demand zones. If we mark one on like this is the kind of area that I'd be interested in buying from. And that's going to lead me on to my next point on liquidity. So when we get triple bottoms or triple tops in a market, these are often a very good way to trade in the eyes of a retail trader. But the problem we have with triple bottoms and triple tops, double bottoms and double tops, is liquidity. What liquidity is, it just refers to orders. So basically, the market is going to continually sweep out highs and lows to take out stop losses of traders, trigger breakout trades, and so on. So here's a double bottom, just marked on the chart, as you can see. Now, obviously, this is a good area for retail traders to buy from. They also like to buy when we get a breakout. So let's say then this is a great position. We now have retail traders buying in here, and we have retail traders buying in from the lows. So we know that there are buyers there with stop losses under the lows. We know we've also got breakout traders who are looking to buy when the market breaks out. They have just been triggered in as well. So what we'll often get in a market is a false breakout like this, where we get a double or triple bottom. There's buyers there. Then we get a false breakout, which attracts more buyers just there. And then we get a big sink from the market like so, which sweeps out the lows, takes out these buyers, then finds support somewhere, and then potentially make its move to the upside, all right, or potentially continue down. But this is a very common formation in the market where liquidity really plays its part. So if we just clear this off real quick, then I'll show you the same thing happening in the current market price. We can see here then triple bottom. So we have buyers there, and buyers there. We can also see, kind of disregarding this wick or potentially including the wick, that we've had a breakout kind of move. So we'll have breakout traders here, we'll have breakout traders here. And what the market does is push up to get those breakout traders into the market along with the buyers that are already in. And then a sell-off will occur that's going to take out those breakout traders, pull them down into a loss, take out their stop losses, free up some more liquidity for the market. Then we have that little bit of choppy consolidation before the market fully pushes down and pushes through the lows and trades into that first zone we spoke about, clearing out these traders as well. So triple bottoms, triple tops, double bottoms, double tops, all of these equal low or equal high formations are a very, very bad way to trade, because what they actually do is entice people to buy at really dangerous areas, at very clear areas that the liquidity will then go and sweep out. So if I ever see equal lows or equal highs in a market, I am never looking to buy, I am never looking to sell until we get a push through that level and a reaction from somewhere more important. So that is the whole retail trade broken down and why it doesn't work out very nicely. And you'll see the same exact patterns repeat time and time again in the markets, and you'll see the same failures occur. So what was my personal setup, my smart money setup? Well, if we clear the charts off real quick and we go back to previous price action, I'm going to start on the daily to show you the whole basis for the trade. Now, what we had going on AUD USD then was essentially a downtrending market. From this point, we have lower low, lower high, lower low, lower high, lower low, and this lower low has come into this imbalance area. So it's not really telling us much yet, but if we just focus on the current structure, we can see quite a few things that are going to give us near-term trades, which is obviously what we were looking for. So first things first, then we have the trending structure intact. But whereas people will see this as a break of structure, this initial push here, I was more so interested in the fact that we'd come up, cleared out the liquidity above these highs, traded into a supply zone, which you'll see quite clearly on the 4-hour time frame, and then began selling off. So if we just mark this zone out, you'll see that the liquidity was then swept over these relatively equal highs. We filled this imbalance or market inefficiency area like we spoke about earlier, retested a supply zone, and then started moving into a downtrend. What we can also then see is the liquidity that we spoke about forming a floor of equal lows in the market that we know the market is very likely to take out. We can also see then another little demand zone sitting just below that, which will be the primary target for the trade. Because we know that, worst case scenario, the market's going to come and take out these lows and then begin its move up. So if we can target that area, we are very likely to actually be fulfilled on a profitable position. We do have a further imbalance beneath that with another demand zone down here, which we could focus on. But for the meantime, we should just focus on a modest target for a modest successful trade. Moving back to the topic of the trend line. Yes, we've had a trend line break, but what does that tell us? Well, quite the opposite to what it may tell retail traders. Retail traders see a trend line break and want to start buying. I can see that the trend line break did not break the significant structure. We've actually still been maintained by this supply zone. And also, it's attracted buyers, right? So it actually acts as a roof of liquidity itself. So this is kind of trend line liquidity, where we know that orders are going to pile up once we get a breakout. So this is a little bit of a buyer induction, where a load of buy orders are going to start accumulating before the market then sells off and takes them all out, freeing up more liquidity. So what is the basis for this trade then? Well, we've seen on the higher time frames a liquidity sweep, imbalance fill, and supply zone retest. From there, we've seen the market move bearish, first of all breaking this point of structure, and then making lower lows and lower highs consistently. We can still see that happening, along with essentially 4 equal lows. We have equal low, equal low, equal low, and another one over here. But the primary focus for me is just these 3 equal lows, this triple bottom, so to speak. Beneath that, we have an imbalance, which leads us into a demand zone. And then obviously the trend structure is still intact to the downside. So my trade was actually taken using this refined area. If we just refine this zone down to the 1-hour time frame, and then we executed from here and brought the market down. And I did actually close this trade early around this point due to it coming close to the end of the week. But if we look how that played out, it played out very, very well. The trade was closed out around this area for 5.5% profit. And then when it pulled back, another position was put on after this pushback up into, as you will see, a supply zone area, which is this candle here, refined on lower time frames. And then we had, once again, another nice sell-off, which brought us all the way down into that zone. So as you can see, 2 wonderful opportunities presented in the complete opposite direction to what a retail trader would have been doing. So the smart money approach brings us a 5.5% profitable short and another 5% profitable short down into this area, whereas the retail trader would have taken a breakout loss, a loss here on this run up, or potentially a break even if they're well managed, and then another loss when the trend fails to shift. So as you can see, the smart money way of trading is much more effective, and also hopefully from the example, you saw that it was broken down with more logic. So the retail trader was kind of just sticking lines and indicators on the chart and then trying to trade off those lines and indicators. Whereas we've actually broken down what's happening in the market, the battle between the buyers and sellers, the filling of imbalances, the sweep of liquidity that takes place, all of these things, the retest of supply and demand areas, what supply and demand areas are and why they work, all of these things combined to help you build a clear picture and a clear image of what's actually going on in the markets. So I hope this video has been beneficial to you. I hope you've learned a thing or two. If you are trading retail methods, I would probably advise that you just stop while you're ahead. And start to focus on a clearer price action view of the market, following the flow of orders, and learn the battle between buyers and sellers and how it takes place in the market, in line with liquidity, inefficiency, supply and demand, and other concepts. If you've enjoyed this video, please drop a like and make sure you subscribe for future episodes of Retail versus Smart Money. I'm going to be breaking down a lot of trades in this way. There's a lot to learn from this. I hope to see you in future videos. Thank you for watching, and I hope I've provided you value. I'll see you in the next video.